Welcome back, One2 Investors. Today we're going to be talking about a certain company that won't be affected by the market crash or the recession, which now you can see that Dow Jones is actually almost at its peak already. Yeah, so at its all-time high. So I'm going to be talking about this certain company that this company can actually do better in the recession than other companies. I know it sounds too good to be true, but it actually is. From the graph that I'm going to show you right here. And yes, it's actually true. And I think you already guessed it by the title of the video and also the picture that you've seen. Alright, so you've guessed it. It's Padini. So why would I say Padini? Because Padini is like it's just a clothing brand company. It's consumer based, so people come and buy and everything. So why would this company do good during the recession? Well, I'm about to tell you now. So middle income bracket or lower income bracket, especially those foreigners who come Malaysia to work. Yeah, you see Padini as cheaper than usual brand clothing. Yeah, you've guessed it also. This shirt, yeah, this shirt is from Padini. Yeah, don't worry, I'm not a cheapskate or anything, but I can tell you that this quality of shirt is not exactly the top-notch quality, but it's not exactly like those cheaplak quality that you see all those pasar malam see. They are middle range qualities, but at a cheaper price. If you compare it with Uniqlo, H&M, Zara, all these companies have they sell clothes a little bit higher in price compared to Padini, but the quality for me my personal opinion, not to trigger anyone, but this quality, the one I'm wearing now, is actually from Padini, and it's actually quite okay. I'll guess it's quite comfortable. For me, it's to my liking. This company, Padini, also owns a few other smaller companies, which is like Authentics, Seed, Padini, Brands Outlet. Yeah, so I actually personally go to Brands Outlet to buy my shirt and pants. Yeah, this shirt actually is three shirts for 50 ringgit. Yeah, that's how cheap it is. Okay. So enough chit chat about how good this company is or how I think it is good. I don't know whether it triggered anyone or something, but okay, now we will get straight to the financials in terms of profitability, revenue wise. Yeah, so I'm going to break down these three sheets that you will see in any company, which is the income statement, balance sheet, and the cash flow statement. Sorry guys, I have to bring in the big guns now. So, okay, so we'll be talking about the 5 years cumulative annual growth rate, the CAGR of this company. So, okay, so the revenue itself for the 5 year CAGR is 17.99%. Wow, that's amazing, right? Yeah, wait till you hear the rest. Earnings per share 18.31%, net income 18.26%, profit before tax 17.51%, and operating income 17.26%. Oof, laptop gone again. So okay, so I just want to mention their revenue, net income, everything, EPS, all goes up at least 15% a year. Don't you think it's great? Yeah, at a PE lower than that. So you see yourself lah, you think if, let's say if you calculate the PE over the growth, PEG, yeah, you will know that it's currently undervalued. But I will let you know later how undervalued it is. And also their revenue has been growing year over year from 1.57 billion in the year of 2017 to 1.68 billion in the year of 2018. amazing, right? Yeah, this goes to show that their management is doing things in the right way. And also, you think that a trade war between US and China has got to do with this? No, it has nothing to do with this. No trade deal, tariffs or anything is affecting Padini at the moment. But if the stock price fell substantially over the few months previously, and also right now it's slowly starting to recover. By now, I made this video, I think it's already recovered quite a bit. Okay, so here's the main reason why. So Padini has its revenue mainly only from Malaysia. So 96.5% of their revenue, current revenue now, is made in Malaysia only. So growing population in Malaysia will definitely increase the revenue in Malaysia as well. And all those foreigners coming from overseas to Malaysia to work, yeah, some of them, because they're paid low, so of course they want to look for a cheaper alternative to buy clothes, pants, cheap clothes, cheap pants where they can use every day. And also they have recurring income from these people, because they think, like, I have this mentality, I have this mindset that I buy cheap now compared to my friends. Like, let's say for example my friends spend like $100, 100 ringgit on a shirt, and I only spent 3 shirts, 50 ringgit, so I get 6 shirts for the price of 1 shirt that they bought. So I can change fashion however I want, how long, how short of a period I want. So this actually helps generate more revenue for Padini. If people have this mindset that, oh, it's so cheap to buy this kind of clothes, I can anytime change, I can also give, like, those clothes that I don't wear anymore, too tight, too loose, I can always give it away, orphanage, or just donate it away. Yeah, you don't have to throw, you just give other people, let other people use. You can also, this is the reason why I like Padini, is because you got wide variety of options. You can change your clothes anytime you want. Boom! Laptop is back again. Yeah, so right now I will be breaking down some numbers on the income statement, balance sheet, and also cash flow statement. So we'll start with the first one, which is the income statement. So let's say, okay, so income statement from the year 2017 to 2018, which is recorded in their annual report, if you can go and check it out. Yeah, so their revenue increased by 6.88%. Gross profit increased by 11.14%, and net profit increased by 13.2%. So also their earnings per share also increased by 13.21%. So this number grows every year over year. So I can say that their management is doing the right thing right now. So okay, enough with the income statement. So we can know that the income statement is, I will rate it A grade for the income statement. So okay, let's go to the balance sheet. So the balance sheet in terms of assets, liabilities, and equity. Okay, so from 2017 to 2018, we'll see that their total assets increased by 4.84%. Relatively marginable increase, but as you see, their total liabilities in terms of short-term, long-term debt and everything, all the liabilities decreased by 17.72%. Yeah, this is a good number. Yeah, so if assets can increase, liabilities decrease, what does it mean? Meaning they're using their cash to pay off their liabilities. At the same time, they're also getting more assets. That means it could mean that their cash generated, we will see in the cash flow statement later, it could mean that their cash flow profitability for maybe 2017 2018 will be a lot. It could mean that, we will see later. Okay, so for their balance sheet, I will also rate them an A at least. Yeah, so this company is actually doing really good. So far we've covered income statement and also balance sheet, which is both pretty good. Okay, so now we will move on to the last statement, sheet, which is the cash flow statement. So cash flow statement, okay, so for their cash flow statement, yeah, so I can see that the cash flow from operating activities decreased about 25.79%. Oh, that's a really bad thing. But wait, you haven't seen the full picture yet. So we'll see. We'll also look at the cash and cash equivalents for the year of 2018 compared to 2017. So this one increased by 8.27%. Why? Their profit grew up year over year. Their income grew year over year. Their revenue grew year over year. But why did the cash went down? Why did they lose cash in this year? So we shall see that the reason why that their cash is going down this year is because of the reversal of inventories written off and written down. So it could mean that probably they use their cash to stockpile on a lot more inventories. So you see that the inventories went up. So previously when I said the assets went up, it could mean that they also use their cash to get more inventories. So inventories are also part of their assets. But why did the management want to buy more shirt and pants to stockpile on inventories before the end of the year? So if you see that the fourth quarter, especially towards the end of the year, their profitability spike up. So I think their management actually wants to stockpile on this for maybe coming winter or something. I don't know. Or they could be because maybe the stock market is crashing or something. But they still have plenty of cash left. So it does not worry me too much. So in terms of grading wise, I'll say cash flow statement I'll just give a solid B. Okay, so now we'll talk about the PEG ratio, which is the price over earnings divided by the growth. So right now, I use this mainly to grade whether the company is undervalued or overvalued. So okay, so we will take the current price, but this was calculated like 2 months before something, before the price shot up recently. So okay, so current price divided by earnings, what I got was 14.28. That figure, it changed already right now. So by the time you watch this video, it's already changed. So it's best you can do the own calculation yourself. Calculations all are in our website, so you can go and check it out. And okay, so the growth factor that I picked out is the 5-year CAGR of their net income. So the net income is 18.26%, which is stated just now. Yeah, so their PEG ratio 14.28 divided by their growth 18.26 is 0.78%, which you have a 22% margin of safety there. This is good, but by now it has shot up already, so so I don't think you can get this discounted rate already if you were to buy it now. Okay, laptop's gone. Summary time. So what I think about this company, in the future there is no like exponential growth spurt from this company specifically, but it's like near a recession already. We can all feel it already. I think the global economy is like really bull now. Yeah, so I can see a bubble there. So this company is a relatively safe company that I would like to maybe recommend you guys. I've also bought this company. Yeah, so I would say that this company has good fundamentals, good management. So we will see the 4Ms, the one I've always say in our website, in our webpage. Okay, so the 4Ms that I've always talked about is the meaning, the moat, the management, and also the margin of safety. So let's see if this company Padini, has hit all these 4 criteria before. Usually I will take all these 4 criteria into consideration before I start buying this company. So first criteria, meaning. So we already know the meaning of this company. They're a clothes brand. They own a variety of companies. They own a variety of subsidiaries. So we know the company already. So let's move on to the second M. So the second M is their moat. So we will see that this company, if you compare it with other companies such as like H&M, Zara, Zalora, or what, they are a little bit more towards the high end, middle class to high end range, whereas Padini is actually the low end range, which people they target customers from people like me, cheapskate. No, I'm just joking. So low end people who prefers to save money or prefers to use lesser cash, like overseas people who comes here to work, like foreigners, yeah, those foreigners and stuff. So they target this kind of people, whereas normal income range bracket people, to those rich ones, they rather go for high-end brands or middle-class brands. So Padini is not actually targeting this kind of people. So they're not looking at them as competition, as another companies like H&M and everything as a competition. So they have a relatively good moat, which helps this company grow their revenue, their income and everything year over year. This is why I like this company. So this company has moat, a really good moat. Now let's talk about management. So management wise, you can see their revenue, their net income, EPS, everything grows year over year. So I can say that every year this management has been planning and doing their best to grow the company in the right way. So I'll say that this management team that they have is actually really good in terms of a lot of things. Their decision wise, their next course of action, a lot of factors that makes this company grow. So this management, for me, I will give a really good rating. So I like their management. That's why I like this company. And the last thing is their margin of safety. Like I said just now, the PEG is only 0.78%. 0.78. So you have a 22% margin of safety at that time when I calculated it lah. So right now, it might change, it might be a lesser than that, but there is still a margin of safety there. So I like this company is because they hit all these 4 M's that I targeted. I made this 4 M's. I only pick companies that hit all these 4 M's. So thank you guys for watching. I hope you learned something from this video. Thank you. Please like, share and subscribe to this video. Want to invest? Out.